All right, guys, welcome back. This will be part 2 of the how a syndication works. So again, the first video was kind of taking a deep dive of the why. If you remember the center bullseye target, talking about the why behind Code 3 assets. Then we did a part 1 video on the how, which explained a couple different or 3 different ways a single investor could choose to deploy $500,000, some pros and cons with that. Again, none of it right or wrong, just 3 different models to illustrate some cause and effect relationships so people can make decisions on their own. And then this video is going to kind of go through a syndication. Had a number of people ask, what does that mean? And it's just going to have kind of a diagram explaining a little bit of kind of how they look and how they're structured. They're really not overly complex. So we have a simple example here. So let me share my screen and we'll get going here. Okay. Kind of like last time we started, if you're wondering, if you watch the other videos, it'll be repetitive, but if you're wondering why are we starting with an operational briefing? Why is there pictures of SWAT guys on the screen? What are tactics, techniques, procedures? And how does this apply to investing? Those are all great questions. And to get the best answer to that, you'd send an email to SWAT@code3assets.com. You'll get a series of 3 reports, lessons learned from kind of the SWAT experience that I've been privileged to have through my training and experience in that community, and then some offensive and defensive strategies that we've taken from lessons learned there and how we apply them to our life, business life, and investing life. And you'll learn in those reports how everything in the tactical world is based in tactics, techniques, and procedures. The tactic is what we are trying to accomplish. The technique is something we are doing to accomplish the tactic, and a procedure is something that enhances the technique to better accomplish the tactic. And you'll see a little deeper dive on that. It might just be interesting reading for you if you've never been exposed to any part of that world or anything like that. But you'll see some comparisons between the tactical environment and some of the TTPs, as we call them there, and some comparisons how you can use that in your business and investing life or even your personal life. So just send an email to SWAT@code3assets.com. If you do not have those 3 reports, there's nothing, no obligation. You don't have to buy anything. They're totally free. So we'd be happy to have you do that. See a couple disclaimers at the bottom. We are not legal. We're not attorneys. We're not tax professionals, anything like that. You should always seek legal advice, legal counsel, tax advice before you make any investment, whether it's in Wall Street or a syndication or your own account or anything. It's all about a team, and you don't have to be the best at everything. You just got to know who the best is. And if you want a referral to some legal or tax advice, just send an email to team@code3assets.com. Put in the subject line, would like a referral, and just send us a message there saying you'd like maybe a CPA or an attorney or an asset protection attorney or estate planning, or whatever you may need. And we'll be happy to make a referral to you. We don't get anything out of that other than some goodwill. If we can help you move your agenda down the field and help them on the other end, then that's great. So again, kind of like the last video, is just part 2. We're focusing on the how. The first video, the very first one we did on the why, I would suggest if you haven't seen that, you go back and check out the why. It's not just about making money. That's not just what we're doing here. So go back, check out the why, then watch part 1 video of this. And then you can check this video out. So this is just a reminder what a syndication is according to Black's Law Dictionary. We covered that in the last video, part 1. It's just a group of people coming together to accomplish a mutual interest, and typically something to do with a financial interest. So I want to go through kind of what an example of a syndication may look like, how Code 3 Assets participates, and how the deals may be broke down, and kind of how some investors may participate. So what we do at Code 3 Assets is we develop relationships. We go out and develop strategic relationships with people to get into deals. So, before I started doing this, I noted nobody doing big deals and things that made sense and places that made sense. Nobody was showing up knocking on my door at my personal house saying, hey, do you want to be a part of this? So we went out and we started developing relationships with people and kind of vetting them who fit what we were trying to accomplish and who did we find trustworthy and so forth. And then through those relationships, we started to identify opportunities to plug ourselves and other people into. So we do that. We put together teams of professionals, whether they're legal professionals, estate planning, lawyers, taxes, whatever the case may be. Sometimes we refer those to folks. We underwrite deals. We do due diligence on deals. We manage deals, kind of the gamut there. So it's a sponsorship. So therefore, we're sponsoring or advertising, if applicable or appropriate, the deals to potential investors, talking with them about their strategies and if what we're doing fits or not. And then we kind of manage the deals as they go along. So Code 3 assets is on that side. That's kind of what we do in a nutshell. It's probably a little oversimplified, but you can kind of see where it falls on the diagram here. So in the capacity of Code 3 assets, through those relationships or whatever we're trying to accomplish, be it tax savings or whatever the case may be, we go out, we find an asset. Those assets could be real estate, could be oil and gas, could be ATMs. We're going to do a video actually on some ATMs here coming up, but it could be a number of things. My point is it could be any real asset. Remember, the why is we're looking for decentralized real assets that are needed by real people in the real economy. We're not looking at Wall Street funds that are just, well, we won't go into the weeds on that, but we're looking for real things. And if you want to know why behind that, go back, check out the why video, and it'll go a little deeper into that. So we identify an asset that we're interested in. We do some underwriting on that, due diligence, so forth. And then ultimately, we would actually maybe go out and acquire some investors, engage interest before we develop this LLC, or maybe we would develop this LLC on the front end, but we'd say develop a Wyoming LLC, just like many of you may be familiar with. And then it gets divided up into parts. So Class A parts, kind of think shares. Everybody's familiar with Wall Street. So just kind of think shares with this. Class A interest, Class A shares, those would go to the investors that are going to put capital into the deal, and they would own their percentage of the deal, as would be explained in all the documents. So let's just say for this example, the Class A interests or shares, the investors would own 80% of the deal or 80% of the LLC, as is depicted here. And then the Class B interest, which I'll explain what that is, that would be, whoever's doing the work. Some people are bringing the money, some people are doing the work. Whoever's doing the work may get, 20%, 30%, 10%, 5%, whatever the deal's structured as. Here, for this example, we just did an 80-20 split because it's kind of simple. So let's say we plan to raise $10 million and we form an LLC that's divided up into a number of Class A units. And let's say they cost $1,000 each, and we're going to take $100,000 minimum investment. You would end up with 100 shares or 100 pieces of that LLC if you were to invest one unit worth or one tranche worth of investments, I guess. So you get your proportional amount of the LLC. You can get your proportional piece of the tax breaks. You can get your proportional piece of the cash flow, the equity growth, whatever the case may be. These deals can be structured in a number of different ways. But point is, all of this happens not by us, but by professionals that do that. So we have securities attorneys or real estate attorneys or asset protection attorneys or estate attorneys. They all look at this stuff as or if appropriate, and they develop all this stuff. And then they work with, we have a team of CPAs where they specialize in syndications and various things. So they all kind of work in concert together to develop all of this. Then we go out and we get Code 3 assets, which would go out, and we would get the Class A interests or the investors to put money into the Class A interest. So in this example, they would own 80% of the deal, and they would be passive investors, which means they're not out unplugging toilets or managing the deals. It's just they put their capital in, other people are doing the work, and they're looking for the returns or their tax breaks or whatever comes to them as the deal is structured. Then there's Class B interests, and those are the people doing the work. Now, with this, they're going to get a percentage of the deal for doing the work. So the Class B interest could also hold Class A interest. They could buy into the deal. John Doe could be the Class B interest doing the work, and John Doe could also buy shares right alongside of everybody else. So they could get a little bit for doing the work, and they could get a little bit for owning a part of the deal, or however that wishes to be designed. But this is basically what it is. Code 3 assets goes out and looks for and creates opportunities. We find an asset, we underwrite it, we study the markets, see if it makes sense for whatever we're trying to accomplish. Then we come back and gauge interest with investors, or maybe structure an LLC first. It gets divided up in a way that the deal makes sense for everybody. legal teams and CPAs and so forth do it. Then we go out and we find investors and they deploy capital into the deal, take ownership, or their proportional ownership based on the amount invested, and then the Class B interest get divided out for the people doing the work, and the asset is purchased through that LLC. So that's kind of how it's structured, for just a simple sketch. And I know there's a lot of pieces on there, but if you really look at it, there's the Code 3 assets piece, the asset. So maybe that's an apartment building or ATMs or oil wells or whatever. And then there's a Wyoming LLC that owns that asset. And there's a group of people that own the LLC. That's really what it is. So don't look at this and get too confused. That's pretty well what it is. What we like about syndications is the Class A and B interests are aligned, because when the deal makes money, everybody makes money. That's why we like private placements best. It's not, as compared to Wall Street, you can see you're much closer to the physical asset than you are owning shares in Wall Street. In other words, your money's going through a whole lot more machinery and getting kind of whittled down. The returns and benefits and so forth are getting whittled down, the further the capital gets away from you before it hits the actual asset. So you see here, you're pretty close to the asset, and that's what we like about them. So I'm just going to review this real quick. This was in the part 1 video, 506B and 506C syndications. So an accredited investor, again, is you got to have the net worth of $1 million, excluding the value of your primary residence, or you got to make $200,000 a year single, $300,000 filing jointly for the past couple of years with reasonable expectation to continue that. And I'm just revisiting this because what we're trying to get people to do, the call to action, is join our community. If nothing else, you can get information that's totally free to help you become more sophisticated and invest in your own account. If you remember the first video, we showed the 3 different options of how one investor could invest: private placement on their own account, or through a syndication or multiple syndications. Either way, the information is there. You don't pay for it, so just invest a little bit of time. Or if you think syndication may work for you and you identify with the why, the freedom message we have, and wanting to own decentralized real assets that are needed by real people in the real economy, this may be a way for you to go, without having to invest thousands of hours or whatever learning about it. So you can become sophisticated enough by joining a community to understand the deals, underwrite the deals, do things, and understand how to tap into qualified professionals to help you make good decisions. But as you note here, if you remember, under 506B, we have to have a pre-existing relationship, and that takes time to cultivate, whether that's through meetups or whatever we may do, to get to know each other, to see if that's a good fit, so that you're in a position to participate in the future should you choose to. And again, if it's a 506 B raise and we don't have a relationship with you, you'll never even know the deal exists, because we can't advertise. We can't have general solicitation. Whereas on the other side with the 506C, we can advertise, but you have to be accredited only. So you kind of got to see where you fit on the spectrum and make some decisions as to what you want to do to potentially prepare. If you are accredited, then you would want to be on our community list to get our newsletters and so forth. So you get information like this. It's totally free. Comes right to your email box. You get invitations to potential Zoom meetup groups we do when we bring in people in our network to maybe enhance your understanding of various things. It's all about sharing knowledge and working collectively towards a common goal. That's why we started with the why video. It's all about working towards the common goal of more people acquiring decentralized real assets to kind of weather the world ahead, thinking long term, so we can provide generational freedom for ourselves and our family. So go back and watch that video and you'll see why we're so passionate about this. So what can you do? Ask yourself what's important now. If you've already got the SWOT report, or the series of SWOT reports, you understand why we have the WIN acronym and what's important now, how we use that in the tactical environment. If you don't have that, or you're wondering how all that applies, again, send the email to swat@code3assets.com. You get those 3 reports for free. We put quite a bit of time in those. They're a pretty good read. You might find them interesting, whether you want to invest or not. If you want to start getting involved with our community and get on our newsletters and get more information like this, totally free to you, just send an email to community@code3assets.com. Maybe you're trying to position to get in that pre-existing relationship and become sophisticated enough to participate in future deals, or maybe you just want to invest in your own account and you want to be more sophisticated in looking at deals and understanding information. All that's great. Just join the community. We're happy to have you. Anybody that's aligned with the why of of preserving generational freedom in a world of what's otherwise economic chaos anymore, we're happy to have you just send those emails. So with that, we'll talk to you next time, and I appreciate you watching.